I do believe that silver will return to a rally mode. With silver, there is a smaller base of what we call open interest. You can see that the low came in right to the 78% Fibonacci retracement. If it recovers, as I believe gold will recover, because my year-end target has remained 6,000. Anytime it goes either over 80, that's when you consider a market to be extremely overbought. Below 20 is extremely oversold. So we look for the troughs, the peaks and the lows to come in and match. The same thing with the RSI for gold. I think that that's why we saw that massive sell-off. Because to me, if market sentiment doesn't really change, either I'm wrong about my assumption, there was a pivot and it's bearish now, or the only other explanation is taking money off the table by large institutional traders that hold big positions. If we look at the bias in gold, and this is a continuous contract, futures contract, now representing April. I look at, in terms of technical indicators, two major things. The Elliott wave count, for those that aren't familiar with it, Elliott waves theory states that a full cycle has a motive phase and a corrective phase. The motive phase can be seen as 5 waves, 1, 2, 3, 4, 5, where 1, 3, and 5 are impulse waves and 2 and 4 are corrective waves. So we had that, and then we went into our correction, which is, it can be a triangle, but the most standard one is called a zigzag, in which you have an A, a B, and your final C. And the final C on Monday really hit about 4,100. That's a huge correction considering that the market top was about 5,300. And so the way I look at that is we've now completed our 5-wave impulse cycle and our 3-wave correction. And that means, all things being equal, that if the market sentiment that was in play and the fundamental events that initiated that market sentiment still exists and is in play, then the cycle repeats itself, which means that I think we have completed our correction, because you notice that for the last, today and yesterday, it's the first time we saw green candles since this one right here.
Gold's recent dip to 4,100 exposes more than a simple pullback. As Gary Wagner points out here, the market just completed a 5-wave impulse followed by a 3-wave corrective cycle, suggesting potential cyclical renewal. Yet investors must question whether the same fundamental drivers, sentiment, geopolitical tension, and monetary policy, remain intact, or if a subtle shift could invalidate the pattern. Historically, a 1,200-point drop from FAFA's 300 signals deep correction risk that can unsettle portfolios. For long-term strategies, this highlights where the green candles signal cautious optimism rather than certainty. Next, Gary Wagner talks about how these waves set the stage for renewed market momentum.
And so these waves are just loosely drawn. What I'm trying to illustrate is, by the nature of Elliott wave, if the count starts again, the 5th wave has to go above the 5th wave of the prior cycle. And for that reason, I believe that it's probably safe to enter the water again. I don't like to touch it during a sell, because there's a lot more activity to the upside and have upside potential when you're in your motive phase. So this is my basic view of the market, and I'm going to really compress this just to illustrate this point. You can see that gold was sitting around 2,500 back in September of 24, and we have had corrections, but nothing really deep, which surprised me. This correction was real acceptable. It was about I recall, about a 50%, if you put a fib retracement from here to here, came down. Then we had these different colored Elliott waves are using different cycles, but I think we hit our fifth wave here, and therefore our A, B, and C, all things being equal, I believe that the count has restarted, and we are now in our primary first 1 out of 5 waves in the motive phase.
Gold returning to 2500 levels in September 2024 masks broader volatility. As Gary Wagner points out here, the Elliott wave fifth wave is set to surpass the prior high, hinting at upside potential. But investors should question whether superficial chart signals reflect real liquidity or underlying market stress. The prior 50% retracement may appear standard, yet it highlights how shallow corrections can still mask deeper systemic risks. Tactical entries during corrective phases could backfire if sentiment shifts unexpectedly. Next, Gary Wagner discusses why this fifth wave could redefine gold's trajectory.
After that, I'm not predicting that it's going to go to 5,900, but where it almost has to go to fit this theory is above this high here, and that high came in at the highest level ever for gold. So I believe that there is a decent probability, nothing's etched in stone here, but a very decent probability that on this impulse cycle, we will actually break above this former record high and trade above it to some point where I don't know yet, but unless it's a truncated fifth, which is a very rare sentiment, because usually if it comes in lower, the fifth wave isn't fully formed. And you have to realize that within this count, the primary count, there's a sub-count behind it, meaning on a impulse wave one, there'd be a sub-count. If we went to like a 4-hour chart of 5, the correction would take typically 3, and again, 5 and 3 on the corrective wave. So I think that we have probably weathered the down price correction itself as it came down, and still what doesn't fit into the puzzle, you've got to kind of shave the pieces to make it work, which is why I've got to ask myself what was I missing, is the fact that with military action between US and Israel and Iran,
record highs in gold are being framed as almost inevitable, yet the nuance of sub-wave counts and truncated fifths is rarely explained. As Gary Wagner points out here, the market may surpass prior highs, but underlying geopolitical risks between the US, Israel, and Iran could derail momentum. Investors often overlook that impulse waves rely on consistent sentiment. Any abrupt policy or military escalation could fracture expectations. Even chart perfection can't insulate portfolios from sudden shocks, highlighting the danger of mechanical trading assumptions. Next, Gary Wagner shows how geopolitical tension intersects with technical patterns.
The United States has the most powerful military, and the current administration is not afraid to do it. He called it a preemptive attack because he said the world is not going to see Iran become a nuclear power. And for whatever reason, at the point in which it started to correct here and down and recover, we had a lower high and a lower low than the previous low. This was the previous low here. That tells me that not that it isn't following the playbook, because it is fundamentals that move the market, but the bullish fundamental and the market sentiment behind it really didn't change. There were no events that made me say, I mean, yes, gold was overbought at that point technically, but I don't think market sentiment changed so much. So I think we saw this last sell-off as an exaggerated low. And I believe, and this is just a theory of mine, that what would cause it if market sentiment didn't shift from bullish to bearish would be large positions, the whales, so to speak, in the industry that are holding the largest position, deciding to take money off the table. That would cause what we've seen, even though market sentiment didn't change.
Right, yes, that makes ton of sense.
Market reactions to military threats often exaggerate technical patterns. As Gary Wagner points out here, despite a lower high and lower low, the core bullish fundamentals for gold remained intact, suggesting large institutional profit-taking rather than a sentiment shift. This underscores the risk that headline-driven sell-offs can mislead investors, masking the behavior of whale positions that quietly manipulate liquidity. For portfolio construction, understanding who moves markets is as crucial as following charts. Next, Gary Wagner unravels how institutional positioning can explain these exaggerated lows.
Sir, so how much of what you have just mentioned would apply to silver, Gary? Would it be very similar scenario for silver as well?
Obviously, there's a similar feel or look to this chart in gold. However, with silver, there is a smaller base of what we call open interest. Open interest is defined as one buy to one sell creates a open interest of one. And when the liquidity really contracts when you compare silver to gold, it makes silver much more volatile, meaning it takes less to move market to tremendous gains or losses. I always explain it is a candle that burns at both ends, burns twice as bright, but lasts half as long. And I think that's what we're seeing in silver. You had the same bias. And if you think about what we saw in gold, it didn't have such a long final fifth wave. Here it's really at the end of October, and silver's at $45 and it peaks at 121. So it did 2x, it did more than double. And gold had already doubled because I believe it started at around 3,500 to 4,000, the beginning of the rally.
Silver's explosive moves often disguise the real risks beneath liquidity constraints. As Gary Wagner points out here, smaller open interest makes silver far more volatile than gold, capable of doubling from $45 to $121 in a matter of months. Investors rarely hear that this extreme swing isn't just bullish momentum, it's also vulnerability to sudden reversals. While gold's fifth wave was shorter, silver's stretched rally hints at higher risk of sharp corrections, demanding careful portfolio sizing. Next, Gary Wagner discusses how these technical dynamics shape silver's short and medium-term outlook.
But if you look at this move here, you can see that the low came in right to the 78% Fibonacci retracement. Market technicians such as myself consider a 78% retracement, and think of it this way: you buy a stock at $1, it moves to $2, and then it corrects in a short period of time to $1.25. That would be a 75% retracement. That is a severely deep but acceptable correction. And when we look at the moving average, it also broke through there. But we saw a phenomenal move, much greater in terms of percentage increases as silver rallied to its new all-time record high above 120. And then it sold off much greater. When we look at these real bodies, it came back down to 66. So it is similar in fashion, although the upside move had a greater percentage gain. The corrections had a greater percentage drawdown.
Right. And so would that mean, Gary, that there was more damage done to silver and it could take potentially longer for it to recover to those highs?
Well, no, I don't think so, because if it recovers as I believe gold will recover, because My year-end target has remained 6,000.
Fibonacci retracements reveal how violent silver's swings can be compared to gold. As Gary Wagner points out here, the 78% pullback from its peak above $120 down to $66 demonstrates that deep corrections can coexist with strong long-term targets. Investors must understand that these swings aren't failures, but technical resets, and recovery may be contingent on liquidity and market sentiment rather than chart patterns alone. A deeper drawdown could stress smaller accounts or leverage positions. Next, Gary Wagner shows why such retracements don't derail silver's broader rally potential.
I haven't changed that. I came out with that October of last year. And if it does hit that, because it came very close, but close isn't hitting your target, beyond 55, 5,600, came very close and it corrected, causing technical chart damage. And what I'm going to pull up is I've got the MACD here and stochastics here. You can see how this peak aligns with this peak, and this is the stochastics, and it came down and it predicted a bottom here. And if you look to where it was, yeah, it was, but it was a short-term bottom. And then anytime it goes either over 80, that's when you consider a market to be extremely overbought. Below 20 is extremely oversold. So we look for the troughs, the peaks, and the lows to come in and match these stochastics. The same thing with the RSI. It's a little bit different, but I do believe that silver will return to a rally mode. You can see that just like in gold, let me go ahead and just like in gold, came up to this high, and the low came right to the 78% retracement, or actually just a little bit below that.
Overbought indicators often exaggerate fear in silver's short-term corrections, as Gary Wagner points out here. MACD, stochastics, and RSI align to suggest that previous lows were short-term, not structural bottoms. Investors tend to panic when prices touch retracement thresholds, overlooking that technical oscillators are context dependent. Silver's alignment with gold patterns indicates coordinated commodity behavior, hinting that diversification across metals may stabilize returns. Long-term portfolios should view these short-term dips as tactical entry opportunities, not alarm signals. Next, Gary Wagner discusses how technical overlays confirm silver's ongoing rally potential.
And there was chart damage, absolutely no doubt about that. But it's still within the confines of an extremely deep and extremely harsh, but an acceptable correction rather than that pivot from bullish to bearish. And so therefore, I believe that we could still see a strong recovery. Nothing's changed fundamentally. There's still military action. Our administration intrinsically creates a lot of uncertainty. And of all the presidents I've seen for the last 20 years, our president is not afraid to use the military, even on a preemptive strike. And that we haven't seen really with any other presidents in decades. And so therefore, I believe the fundamentals, bullish fundamentals, are still in play. As I explained for gold, I think that that's why we saw that massive sell-off. Because to me, if market sentiment doesn't really change, either I'm wrong about my assumption, there was a pivot and it's bearish now, and I would have to adjust for that, or the only other explanation is taking money off the table by large institutional traders that hold big positions, and their weight is strong enough where if they're liquidating longs, they're selling into it, and that would explain why this rally has been so volatile.
Volatile sell-offs often disguise institutional behavior as market panic. As Gary Wagner points out here, the chart damage in gold and silver doesn't reflect a shift to bearish fundamentals, but rather large traders taking profits against stable bullish sentiment. Investors rarely see that liquidity pressure from whales can create outsized volatility without any change in macro drivers. Military and geopolitical tensions amplify uncertainty, but don't negate recovery potential, highlighting the disconnect between headline fear and market mechanics.